Hey, everybody, it's a way too early edition of No Vacancy Live today. What the heck am I doing?
I'm Anthony. Welcome to No Vacancy Live. That's my friend Glenn.
You're watching the #1 show in hospitality.
Hey, everybody, welcome to No Vacancy Live. I am Glenn Hausman. Anthony Melchiori's not here this morning because I'm a super dum-dum and I screwed up my travel schedule and I still wanted to go live today with our guest. So I'm in my travel clothes. At any minute, I might have to bolt to LaGuardia Airport, depending on what Google tells me to do, because don't we all live our lives living by what Google says we should do? But before I disappear, going to the incredible NEWH conference. Of course, they're a great organization for networking and empowerment, and they do a lot of great scholarships for people coming up in the hospitality industry, particularly around the design community. I'm going to be broadcasting Friday Night Audit from down there tomorrow night. I'm going to be doing recording another podcast down there. And of course, on Saturday, what I'm looking forward to most is being a guest on a panel talking all about the kind of podcasting, the stuff that we're doing here right now. But you're tuning in for other information. You want to know what's going on in real estate. And I'm curious, are we buying? Are we building? Are we staying on the sidelines? I'm just going to fantasize about actually owning hotels over here. But one guy that's helping get deals closed is Andrew Broad, managing director over at Robert Douglas. Andrew, thanks so much for being here today, particularly since I screwed up my schedule. How are you?
I'm good. Good morning, Glenn. How are you doing?
I'm doing great. Thank you so much for being here today. So I'm excited to talk to you all about what's going on in real estate. And, you're part of a real estate investment company. So I'm really curious as to what you think is happening today. And I get a lot of mixed messages, and I get that it appears it's important depending on whatever sector you're in, whatever your goals are, things are different. But let's start with an umbrella approach. What's the overall vibes that you're getting today, February 15th, 2024?
I think that maybe the best way to look at this is maybe what happened in 23 and what we think is going to happen in 24.
Yeah.
We live in the transaction world, and 23 was pretty skinny. We suspect that
transactions down something like 60% in like the last part of the year in particular. Right.
And I think there were obviously the debt markets contributed to that. Every 60 to 90 days, debt got to be more expensive and less readily available. Mm-hmm. But I also think as people enter deals, things like the PIPs got a little more expensive, or there was a PCR issue, or
what does PCR mean for our viewers?
Property condition report. Somebody's done it under contract and they find that the chillers are broken or something like that.
Right. That's a shame, because over here we're all about you got to chill, man. Yeah. You don't want those things broken. Go on. Sorry.
So I think things that may not normally derail a deal, when you pile that on, you get more expensive debt that gets piled on. The bridge breaks and deals weren't happening. Mm-hmm. I think moving forward, what we're going to see is there's obviously a lot of debt maturity coming down the pipe in the next year or two. And that event, I think, is going to force people to make decisions. And the decision could be to sell, because that's a solution for you.
Right.
It could be you just simply need to refinance. I think it's going to be tied very much to where in-place cash flows. As a side note, we just put out our lender survey, and that was pretty critical to most of the lenders we interviewed.
And believe it or not, Andrew, we're gonna talk about that in just a couple of minutes.
So again, we do think that cash flow is a big driver, and again, so if you have a property and you've got substantial cash flow and you've got very conservative debt yield, you may elect today to simply just refinance that loan. You'll have more options than somebody that's still recovering or doesn't have cash flow. So I do think that the amount of debt maturities are going to bring things to market. And we keep hearing everybody wants to chase distress. And I think there is some distress out there, but what I think these events are going to lead to are deals that haven't been on the market. We haven't seen transactions. We're just going to see more.
Right.
And it's not necessarily going to be distressed. I think it's just going to create an opportunity for people to transact.
Right. Yeah. Go on. It looks like you were going to continue.
Yeah.
All right. So, that's a great point of view. And I'm not the expert, but it sounds like you know what I'm talking about. And it mirrors a lot of comments that I have been hearing out there. So it's really interesting to me because what we try to do is we try to put everything into a simple bucket, right? But every single deal is different. The goals are different. The circumstances of the previous deal that got that particular owner into the situation are different. So it creates, a lot of variety of opportunities that are out there. And I've noticed some very distinctive strategies of some companies trying to recycle assets, some companies trying to buy assets that they think are going to be worth more in the long term. And then other companies saying, hey, forget about it. I'm out. I think we're just done over here. Does that seem to make sense to you from what you're seeing out there?
Yeah, I mean, look, I think I equate it. I'm going to look at the residential world for a moment.
Yeah.
I think if you had kids and you're empty nesting and maybe it was natural for you to maybe sell your house,
right,
with where interest rates have gone, maybe you're not selling your house. Right.
Yeah. I'm raising my hand because I've got 2 kids in college and we've talked about it, but I refinanced at 2.9. And now if I bought something that would kill it, I'm getting to, I cut off a lot of years by doing that refinance. So I feel like even if my property taxes are going up, it's still better for me to just, hang out.
So I do think there are companies out there that may have owners that were looking to naturally retire or get out,
right,
and they've delayed that decision. They've made their money, they made their wealth, and look, it could be that it's time for them to move on and enjoy the rest of their life, whatever they're doing. I do have this small concern we have, and I think you've talked to the brokers. We've certainly seen it here. We've seen a dramatic increase in sort of broker opinion of value work. People asking us, what is our stuff worth? What could we do? What's the strategy? Yeah. And we're hearing this from a lot of people. So, the question is, if we see a lot of inventory sort of hit the market at one time, right, could that have an effect on value?
I would think, as someone who doesn't know, that's a lot of supply and demand. If there's a lot more product out there, then typically it'll take a hit with how much you could sell it for. Yeah.
Now, again, we haven't seen that yet. And I do think that there's still a lot of capital chasing opportunity. The question will be, does that have an impact on valuation? Maybe. I firmly believe that the residential market, the main reason we haven't seen a decrease in home values is the fact that there's just no inventory available and you've got a lot of demand for it. Right. So I again, this goes back to I'll kind of tie in our survey again. Mm-hmm. Interestingly enough, when we surveyed lenders, nobody thought rates were going to go up, right? Percentage.
Right. You mean for 2024? 24. Because we've heard a lot of chatter about rates going down periodically throughout the year based on signals the Fed has sent out. All right, please continue.
And most of the people we surveyed agree with that, but there was a percentage that said, hey, rates are going to stay flat. And the Fed, there was some indication maybe a rate drop was going to happen. Now that's been pushed off. Look, I think most people, and I'm one of them, do agree that over time we're going to see rates come down. Mm-hmm. The question is when. And I think that it's probably going to happen later than people thought, let's say 30 days ago. And that showed up, if you look, 5-year treasuries jumped 40 bips, the inflationary report. So again, everybody we surveyed does not think rates are going to go up, which is good. Yeah. And I think what that's doing is we're kind of in this situation where buyers are starting to get a little bit more bullish, and maybe the way they're doing this is they're bringing their exit cap rates down in their models. Right. And we have sellers that, because of, let's say, maturities, are being forced to be a little bit more realistic. And those two events will compress, that bid-ask spread. In my opinion, really the two things that are going to help get things done this year.
Yeah, and when they're compressed, that means you're fostering more of an environment for deals to potentially get done.
Correct. And look, I don't you always say, "Oh, I'm chase." You hear, I want to chase distress or opportunities.
Right. I only look for off-market deals.
I think look, and I'm not saying that there aren't good deals for people and there aren't opportunities to come into an asset and improve them, whether it be a PIP or putting in a new revenue management strategy, whatever it might be. But it's not going to be like fire sale situation. It's going to be deals will get done, fair and reasonable deals. Buyers might capture a little bit more of the upside.
Yeah.
I look at this in a very frothy market. When a buyer comes into something, they might pay the seller for some of that upside in the deal.
Right.
In a market that's, let's say, truly a buyer's market, the buyers start buying more at like as is value, and they capture more of the upside in the deal.
Right.
I think in a balanced market, those parties tend to share. And again, it breaks down. Maybe the buyer's getting 80% of the upside and the seller's getting 20% of the upside. But we get into this market where I do think that there will be an opportunity for sellers to sell their assets at a fair number and buyers to buy at a fair number. And I think we're starting to enter that. And keep in mind, like, an economic recession, wars, like all these other things are concerns. I think,
but we always have the backdrop of concern.
Correct.
Yeah. And now you're going to start to hear, Andrew, and this is my new shtick here. We're going to start to hear about how we can't do anything because of the presidential election. We don't know how policy is going to be, even though policy doesn't ever really change that much because government is, stuck.
Yeah, I don't know. I don't know if this. Yeah, every time we hit an election year, it gets a little weird. But I don't know about this one. I think there's bigger things happening in the hotel space than the election. But
yeah. Right. Yeah. I will say this. So, all right. I'm curious about Andrew, because you're such an expert in this. So interest rates are at X%, and I'm interested in getting into property. Do I wait for 60, 90 days for hopefully that to drop, assuming the deal is still there and I could get money cheaper? But at what point do the cost of goods and services and all of that to put in a property improvement plan to get the property in the condition that I want it to maximize my investment opportunity? How does all that work in people's brains?
I don't know. I think I think it was Warren Buffett that said this. I think trying to time the market is very difficult. Right. I think you're better off forming a thesis of, what markets do you like?
Right. And over 10, 20 years, it'll do this as opposed to the next year.
Yeah. I actually, it's interesting. I was trying to find this data point this morning, and so I'm going to throw something out that I don't know if it's accurate, but I was trying to figure out like what's been the aggregate change in CPI from 2019 to today.
That's the Consumer Price Index, right?
Yeah. Mm-hmm. Yeah, Consumer Price Index. And I Googled like multiple sources, and it came up with about 22%. Mm-hmm. So $1 in 2019 is where they call $1.22 today.
Right.
Which means that, if you're renting rooms for $100 in 19, if you're not renting rooms for $121 today,
right,
you're not back to 19 numbers. Right. Inflation adjusted 19 numbers. So again, timing the market, you can wait. I mean, if that's your thesis, but you could miss an opportunity. And I always tell these people, you don't own the cash flows from before. You own the cash flows moving forward.
Yep.
And I think, when we came out of COVID, leisure looked really, really attractive. And
it did. And everybody fled from deals in urban cores. There were a few companies out there making a lot of, buying distressed properties or just purchasing hotels. And they seem to be on the winning side today from that decision.
I agree. And I think, you just have to, you kind of analyze like what's going to happen moving forward. And that's where it's gotten really difficult. I don't like to use the word like pendulum swinging back, like, leisure's going.
Right.
I think COVID took this industry and it was like a jar of like, I don't know, Jello or something. And it got all shook up. Yeah. And now it's starting to settle, and it's cloudy. Like we're starting to see like different patterns sort of emerge. Like I think we're going to end up with some sort of new norm moving forward. And I do think that, maybe companies will come back to work, but you'll get Fridays at home or whatever it is. I'm working on a project now where they've done really, really well with a corporate client who used to do like big meetings, like convention size meetings.
Right.
And now what they're doing is a lot of smaller meetings in their backyard. So that that hotel in their backyard has been the beneficiary of that sort of shift in the way that company is training their people and conducting their business. So I think we see sort of like new-ish patterns out of this, and we can't ignore the fact that people have moved to places like Nashville and the Mountain West and Florida.
Yep.
I do think there's some of that's going to play out in the long term, but again, in the short term, I think we're all trying to figure out like where is this industry going in that particular market, and again, how you approach a Boise might be different than how you approach a San Francisco or how you approach a New York.
Right. Agreed. And unless you can't, unless you have, some sort of omniscient understanding, you've really got to understand the dynamics of every single market. And that's why it frustrates me that we don't have a better, tool to talk colloquially about the state of the industry than what the entire country seems to be doing, right, in any particular category, because it gives us a sense, but it doesn't really give anything specific because this is such a street corner operation. And I will tell you, Andrew, I was in Asheville, North Carolina last fall with my friends over at Rains Co. for their annual conference. And the amount of highway construction and the amount of the airport was under construction, they are in the middle of a big boom right now. And that seems to me an indication of a market where you could probably build new hotels or reinvent existing hotels.
Yeah, good luck at Nashville. I know the market well. I know the road they're putting in. I think Asheville's a great market.
Yeah,
right.
The Rains guys have done some great projects down there. And I think that because they're in that region, they kind of anticipated what was coming and got some great, properties open over there, for example. Yeah, go on.
No, and look, we've seen a number of companies where they know what I'll say. They kind of know their backyard, right? They know the street corner that's better than the other street corner.
Yep.
There's a lot of value in that, and sometimes people forget that this is a location business.
You're so right, Andrew. Before you continue, it's just it's something. I want to just make a connection for viewers. Everyone has that area in your neighborhood where that corner doesn't do well. And you see that restaurant that's going in there and you're like, oh no, why did they get that space? Because 6 months later, they're gone, right? Yeah. So it's the same thing with understanding how everything works for hotels.
Yeah. And look, we have something on the market now. It happened to be a market I've lived in for a while.
Yeah.
And just knowing like where the hot little area is and why one hotel works and one doesn't, because there is a pretty big disparity between the top and the bottom, and that doesn't happen in all markets, but it does happen in some. Sometimes understanding that is really very valuable, and so I think the regional players that know their backyard, know where the growth is going to be, know what companies are coming in, the demand generators that are going to feed their hotels in the future is a competitive advantage, right?
Yeah.
I think the other thing would be, from a management standpoint, the type of product you're very good at. Like if you're a good extended stay operator, build extended stay. Don't go build the Ritz-Carlton. If you're a luxury operator and you do that well, like sometimes staying in your lane and doing that well is something that gets you should recognize. I think, and look, there's things we can't control in this business, and there's other things we can. I think you have to do your best to control the things you can. This is a service business. Yeah. At the end of the day, like it's not always about the PIP or the nicest mirror. It's a combination of a quality product, good staff, offering something at a value, doing the things you can control. And look, there's a lot of like on the other side, like insurance has become a big problem. Not a big problem. It's just becoming much more costly.
We haven't talked enough about this. I started hearing about it in Florida, but apparently this seems to be nationwide. What specifically is going on here that's driving these insurance rates up so much?
Well, storms in Florida. The other thing is that as people sell their properties, the insurance companies, really the lenders, are asking the borrowers to reset the replacement cost. And so because the cost of construction and replacing these things have gone up so much, the owner might have had a policy with a replacement cost of $20 million. You're buying it for 30. You got to put in $40 million for replacement cost, and the amount of claims in an area like Florida has resulted in insurance, not going up just a little, but sometimes 150, 200%, and in some cases, insurance companies completely pulling out. So it's an issue. Again, we always hope that the rates and revenues will outpace the pressures in the P&L.
CoStar seems to be predicting that we are there for that right now. But again, it's tough to make those profits because the margins have gotten a little bit slimmer. But I'm curious, man. I'm getting ready, leaving here in a few minutes to head over to Nashville. Nashville's been a darling for so many years for hotel development. You're saying, for example, that it's still going to be, rocking and rolling. What the heck? Is it because they're expanding so much in terms of population? It's unbelievable.
I think it's an extremely attractive city for so many reasons.
Yeah.
And one of our partners, Evan, lives down there, and we're working on a couple things. And certainly downtown has clearly shown it can handle the supply for demand downtown. We have seen a little weakening sort of on the fringes, but if you look at the airport market, for example, all right, it's softened, but now they're doing a multi-billion-dollar expansion, right? So, you might look
when you have X amount more planes coming in, inevitably you're going to sell X amount of rooms.
Correct. And look, you could say, hey, it's a little weak now, but over the next 5 years, as this thing comes online, that could be a great bet.
It sounds like a good time to start early planning then on a property.
Look, or maybe there's an opportunity to buy something there today at a basis that's super attractive versus building new. And it may not look great today, but in 5 years you look like a genius.
Yeah.
I really think at some point in time, betting on San Francisco is going to be a smart thing to do.
Right. Just not necessarily today.
You might look very foolish today because of where the market is, but if you think San Francisco as a market's going away, I'd argue pretty emphatically against that. Yeah. I think I think if you again, New York's got things going on. I was just
going to try to segue into New York because let me just set the stage for this question that I have for you, because New York City pre-pandemic, and it was all about expansion. There were so many rooms that were added that in 2019, when everyone was making boatloads of money, New York City was already having trouble pushing its rates. And the expense to run hotels was so much that it was getting more difficult for hoteliers. Well, there's been a reset. Hotels have closed. The migrant situation has impacted New York City's hotel system in a very serious way, taking many, many hotels out of renting every night and providing homes and services for these people. So now it seems like it's a toss-up. All the dynamics of the New York City market have changed. It's one of the reasons why I'm thinking some of those people like MCR that bought the Sheraton in Midtown probably made a really good decision. How are you seeing New York City?
Well, you also had the change with like Airbnb rules.
Correct. And to let people know, you cannot do regular Airbnbs anymore in New York City.
Nope.
So that is a massive, massive change. That under, even if the migrant situation wasn't there, I think would still buoy the hotel development sector.
Yeah, look, Airbnb, I think is, unless they change the law, which I don't think they will do, that's a big change for the city that will have long-term impact. Mm-hmm. The migrant situation is interesting because, this is clearly a national issue that's people have a lot of opinions on. The question becomes, will this issue be solved? I think that's a big load to carry and figure out. I think the bigger question for New York is, will the New York taxpayers be okay with spending this money indefinitely?
Right. Yeah.
And is this solution of using hotel rooms, permanent solution? I don't. By the way, I think it's going to be here for a while.
It is. Well, even if New York City woke up this morning and said, we're going to build 10,000 units for these people, that's still years away.
Years away. Or if the federal government does, again, it's a very big issue. So I would argue that you have this demand, right, from the city of New York, who are renting rooms and taking up inventory, and it's really really sort of reduced the supply of rooms in New York City, a market that's got a variety of demand generators, and there are going to be pockets in New York that do better than others.
Yeah.
Right. Again, going back to the comment, the street corner. Yep.
Maybe, exactly.
Maybe you don't want to be on Lexington 3rd. You want to be over here. And
you definitely. It's definitely better, to be on, Lexington than like 2nd Avenue, for example, unless you're by the UN in September.
And look, I think guys, and I'm not faulting him because I think he was a very smart developer, but Sam Chang figured out a way to build mid-block select service hotels.
Correct. Now, Sam Chang, because people don't know who Sam Chang is probably New York City's most preeminent hotel developer. He manages to find spaces, comes up with properties that others don't, builds them, and typically sells them either when they open or before they're open.
Sam is actually, I believe, he's retired, and I think a very smart guy. Yeah. And definitely took risks and has been on the brink a couple of times. So
I would say that he's probably, correct me if I'm wrong, because this goes back to the 90s, but when there was the initial surge of select service hotels in New York City, I think that he probably had a demonstrable role behind creating that.
I think he did them all.
Yeah, right. Okay, just checking.
Yeah, and look, he was very, very smart, and he he took a city where people thought there was a lot of barriers to entry, and said, hey, I can build a mid-block Fairfield Inn and do well with it, and he did. And,
totally. There was either like flop houses or like real high-end hotels.
Yeah. So again, I give him a lot of credit, and and again, New York's got a lot to offer. It's truly, I think, one of the United States global markets. I don't know if we have any. Maybe I would have said San Francisco, but New York is clearly a global city, and we still haven't seen a full recovery of European and Asian travelers, to the United States. So I think New York is a very hot market right now, and it could be a really good bet. Yeah. I think if you had made the bet 18 months ago, you're pretty happy today. Yeah. And that's kind of why I say San Francisco, because where is this city that hasn't quite recovered, that has the right recipe for coming back. And so people, when I talk to people, I want to be in Florida, I want to be in Texas, I want to be in Arizona, kind of the usual suspects. Yeah. But is there something that's flying under the radar? Like somebody had mentioned to me the other day, Detroit.
Well, I was just
how well Detroit's doing. Mm-hmm. Really interesting, right? Mm-hmm. So again, there's like this macro level stuff that's happening, and then you have this kind of like local market stuff. I'm going to give him credit because I think he's another smart guy. But Russ Urban had spoken to me when he was at HEI. He kind of said, "Hey, I can't fix a market,
right?
But I can fix a building, right?" So he was making bets on markets. He figured out markets he liked, felt like it was the right place to do a deal, whether it's build one or buy one. In his case, he was buying them, and I'm going to bet on the market. Yeah. And I really like that strategy because, I'm a big believer in basis. Like if I can go to a market that I like, and it's a market I like going 3, 4, 5, maybe even longer years out, and I can find a building for a fraction of what I can build it for, and it's got good bones, and I can fix it. Yep. I've always sort of been a big believer in basis, and I know the market likes to look at cash flow, and our lenders like to look at cash flow, and you get better debt when you have cash flow, but if you can go into a Nashville that's trading at X amount of dollars per door and find something for, a fraction of that, it could be a good bet, right?
Yep.
The only issue today is that if it doesn't have cash flow, you're paying a lot of money.
Mm-hmm.
You're paying a pretty heavy load on the interest rate. And so it's made those deals a little bit more difficult. And I think, for sellers, they need to understand that, the discount might have to be a little bit more than they, hey, I'm selling this at a 5 cap, but it's, 40% of where the market is.
Right.
It might need to be deeper than that because, that buyer is going to have to incur a pretty heavy cost of capital for the next year or two until SOFR and some of these rates come down.
Yeah.
So I think it's made those deals. People want to chase distress, but like, what's better? I buy distressed at SOFR plus 600, or I buy cash flow at Treasuries plus 275 to 300, and
yeah,
it's one's vanilla, one's chocolate.
Hey, both equally delicious. Particularly if you can really understand the differences between the flavors. Andrew, so great to see you. Give us a good plug for yourself and Robert Douglas before we wrap up today.
Sure. So if for those that don't know, Robert Douglas is sort of a boutique investment banking shop. We only deal in hospitality and hospitality related things. A couple of my partners got involved in a lot of outdoor hospitality, sort of experiential hospitality years ago. So we tend to get a lot of phone calls on that, but we do debt equity investment sales in any given year. We might do more of one than the other, but it kind of shakes out that it's pretty even, over the course of history. We sort of work as a team. You hire one of us, you hire all, right?
Yep. Cool.
We're not commissioned guys. And I think what makes us a little bit different is that, we'll get involved in strategy. You might come to us and say, hey, we might want to sell this. And if we see what might be a better path, we'll open our mouth and say, hey, you might be better off refinancing this, or paying down the debt and bringing in a partner. So we tend to be a little more client centric than let's say other brokers. And I'm not saying other people aren't good at what they do, because there's plenty of people that are probably better than me. But I think we're very good at sort of looking at a situation and figuring out strategy. It's definitely what makes us a little bit different. And we did just do this lender survey that just went out. We've been doing that for 10 years, just to kind of give people a sense of what the debt markets are thinking. So that's out. We've just rolled out a number of hotels for sale. We are very busy, which is we're happy to say that, because a year ago we weren't this busy. So look, we're certainly seeing things hit the market from our friendly competitors, and like I said, I think transaction folk are going to have a pretty good year.
Yeah. Awesome. Well, thanks, Andrew. Really appreciate you being here. We'll see you soon. I want to thank all of you guys for being here. Make sure that you follow us. If you're watching the show, why not download the audio version of this podcast? You can find us wherever you get your shows. We're there. That's right. And if you're listening to us right now, why not watch us? You can check our database of shows at novacancynews.com and subscribe to our newsletter. Text the word hotel to 66866. That's hotel to 66866. Now, remember, everybody, I want you to you only got one life, so blaze on and be kind to yourself, as Anthony would say. See you guys next week. Bye-bye.